Hey everybody, and welcome back to Mondays with Mike. This is another edition of Mondays with Mike. I know I've been gone for a little while, but I'm back and I got some brand new great information for you. Don't mind the noise. I'm outside, sitting outside in the comfortable, enjoying the sunset today, enjoying the sunrise today. But I got some brand new information for you. Today, I want to talk about credit versus DTI. Credit versus DTI. This is something that is is a very big deal to me. I'm very passionate about it because my job, or one of the things that I do, is I like to help as many people out as possible. And one of the things that I believe that will help our community out, especially, is home ownership. And you guys have already heard me talk a lot about how important home ownership is, and I'm glad that a lot of people are starting to get a good understanding about why it's so important for them to own a home. Typically, when you want to own a house, it usually takes you a couple years to get it set up to actually be able to do it, and that's the problem that most people are running into, which why I wanted to do a video today to kind of talk about it, because most people don't understand that when you get ready to buy a home, you have to plan for it. It's not something where you can wake up and be like, hey, you know what, I think I want to buy a house tomorrow, and just you're able to do it. In most cases, people are not going to be set up that way. You're going to have to do some things in advance to kind of set yourself up for it, and many people know that. So it's not like I'm giving you new news on that. But the problem is this: most people, when they get ready to start setting themselves up to buy a house, only thing they are worried about is credit. That's all we hear: credit, over and over again. My credit, got to get my credit, man. I can't get a house. Credit, which credit is very important. But I want to tell you about something that's the missing link. A lot of people don't understand why sometimes they can have a 700 and some credit score and still get denied for trying to get a home or different things like that, because there's one thing that have been missing that is so critical. When I was growing up, one thing that I remember is it was, at that time, everything was just about cash. Everything was big on cash. I got money, I got cash. Cash rules everything around me. Dollar bill. You know what I'm saying? It was always about just liquid cash that you had. And as I got older, I started understanding that that's not quite the real way that it is. And let me explain. Don't get me wrong, cash is very important and could be the most important thing. But put it to you like this: if you have $50,000 in cash, but I have an 800 or 700 some odd credit score, and I have the ability or access, or a term I like to call is bankable, which we'll get into some talking about that at a different time. But if you have access to go to the bank and get $100,000 or to get $150,000, then really, who has more money? If you see what I'm saying, it's like, yes, this person might have $50,000 cash, but if I have the ability to get $150,000 from the bank, then depending on what project I'm trying to do, I can still invest that money and be able to turn over a better return on my investment, because I have more access to more capital. So that's the type of stuff that I mean, where sometimes it seems like we're always a step late from the big boy investors. If you have any type of plans or aspirations of, owning your own house at some point in time, or ever becoming an investor to where you're going to buy different properties, or try to, flip properties, or you want to maybe have some rental properties, if you ever have any aspirations of that, you have to catch this key thing that I'm finna talk to you about on today. And I'll try to not hold you guys too long. But the term for today, and get your pen and your paper, or listen to this again over and over again. My wife was telling me, boy, ain't nobody trying to get no pen and paper. And I was like, babe, but they have to understand that this is critical especially for our community. This information I'm about to tell you is critical. Okay, credit. Everything you know about credit is cool. I'll go over it real quick. You want to have a high credit score. They want it to at least be somewhere around a 620, different things like that. There's multiple ways to improve your credit. If you guys want me to go into more of a detail about that, if you leave some comments and you say you want me to do a video about credit or something, then leave comments. Let me know that this is helping you, because I'm only doing these videos. I set out to do it because I want to know that it's helping somebody. Now, some of this information might be beneath some of you. Some of you may already know some of this stuff, but I know there are some people out there that this type of video can help. So please leave comments and let me know. And also put more topics on there. Share these video, like the video, and put more topics on there that you would like me to discuss. But for basic stuff about credit, you can go get yourself a secure credit card. And off getting this secure credit card, that's where you're giving the bank your cash up front, and they're giving you a credit card with that balance on there. You can spend some of that balance, and then you pay it off, and you keep doing it. And what that's doing is working up your credit. So, and you can also do a loan. You can do a secure loan where the same situation is going on, but instead of a revolving account, it's an installment account. And like I said, if you want me to do a video on credit, just let me know, and I'll get into that a little bit more. But for today, we're talking about DTI, debt to income ratio. That's what it stands for. DTI is debt to income, and then ratio is what the banks use to see how qualified you are going to be in order to purchase a home. It's two things. It's credit, but it's also DTI. And if I had to be honest with you, and this is the part that I want every single person to start sharing in the community and letting everybody know. If I had to be honest, DTI is more important than credit. Let me say it one more time so you make sure you have me. DTI is more important than credit, depending on what you're trying to do. You can ask real estate friends that you have, or people in your family, whoever understands banking, people who understand how it works. DTI is more important, and the reason why is because if I had a choice between having a person who had a jacked up credit score, but they had a lot of money, as for they made a lot of money, but they had a jacked up credit score, or I had another person who had a great credit score, but they just didn't make that much money, give me the person with the jacked up credit score, because I can fluctuate and help you to fix your credit over time. Remember, I told you it could be a 1 or 2 year deal when you're getting ready to buy a home. So over time, I can help you to get a credit score pushed up, especially if you have money. The problem is trying to twist and move and navigate and fluctuate your DTI, your debt to income ratio. And let's break it down a little bit so you understand what I'm saying. What they're basically asking in layman's terms is, how much money do you make, and how much money do you have allotted to be spent out every single month? Now, it's not a basic equation, and this is what messes people up. They'll say something like, we'll use $3,000 a month, for example. They'll say, man, I make $3,000 a month. I got plenty of money, right? Right, makes sense. Let's say you're going to get a house, and the house is only $1,000 a month. So you say, oh, cool. I got $3,000. I got to spend $1,000. I got $2,000 left over. I got plenty of room, right? Wrong. That's not how the bank calculates it. Many people don't understand why a simple little car that they buy with a $300 car note can be such a big deal where it can knock them out of contention of being able to buy a property. You're like, how could that happen? This is why. This is the missing link. You don't understand DTI. Debt to income ratio works like this. They're going to take the amount that you make, say $3,000 a month, and they're going to multiply it times 40%. Some banks do up to 50%. I've even heard a little bit more, but a good rule of thumb is about 40%. Now, real quick, the reason why they do this is because anytime the bank has to get approved for some type of loan, FHA, USDA, yada, yada, yada. I know this might bore you with this type of information, but the reason why they do it is because in 2008, when a real estate market crashed and all those things happened, they put federal guidelines and different things to make a bank have to say, if they're going to loan you money, you have to prove that you can pay for their house 1 and 2 times over is what they're doing. So the bank can't put you in situations where they loan you money for something that you can't afford, and then the government or somebody is on the hook to pay that money back, because a lot of it is insured. Okay, so what they do is they say, okay, you make $3,000 a month, multiply that times 40%, and they say, okay, you have $1,200 left over. Now that's the amount that they're going to start you with, $1,200. So your $3,000 you made per month instantly turned into $1,200, and that's what's losing everybody. Like, how'd that happen? No, instantly it's turning from $3,000 to $1,200. Now with that $1,200, now they start subtracting bills from that number, $1,200, not $3,000. They start subtracting from that $1,200 to see how much you have left, and they don't count everything. You know, I can't get all the way into it, but they're going to count stuff. A good rule of thumb is things that will show up on your credit report. So they're going to count stuff like a credit card bill. That's definitely going to come in there. That's going to take your monthly payment. So let's say your monthly payment on your credit card bill is $100 a month. Well, that's subtracted from that $1,200. So now you got $1,100 left over. Let's say you got student loans that you pay. It's $50 a month. Okay, that $50 comes off of that. Now you sitting with $10.50 a month. You see what I'm saying? They're going to keep subtracting things. They don't count stuff like your cell phone bill because that's not something you have to pay. They don't count stuff like cable bill. They don't count the place that you're staying. They don't count your rent because when you move to a different place, that rent is transferred. So they count things usually that's going to show up on your credit report, stuff like that. But now, understand this. Now let's add a car note into that and say you had $3,000 starting over. Starting off. They took 40% and said, okay, you got $1,200 left. Now, let's say some of you guys got $500 and $600 car notes, or even $400, $500, $600. Like I said, car note. Subtract $600 from $1,200. All you got is $600 left over, and that amount that you have left over, that's the amount that they use to say how much house you are approved for. So that means a good rule of thumb so you can understand. If you get a house that's about $100,000, now these are just guesstimation figures because different things matter. Stuff like, your interest and your insurance and all that. So this numbers can fluctuate, but a good rule of thumb is if you got a house for about $100,000 or so, right? You figure that house is probably gonna cost you somewhere around $700 to $800, maybe somewhere around $850. It's gonna cost you somewhere about $800 a month, give or take 100 or two. Like I said, it fluctuates, but about $800 a month. So that's a good rule of thumb to show you the house that I bought. Our first house was closer to about $200,000, and that's gonna cost you somewhere around $1,400 a month, if you will, something like that, or it could be $1,200 a month if you have VA loan. So I'm saying it fluctuates. I'm only giving you these numbers so you can have a good understanding of what a house would cost, and so you can have an understanding about where you need to be. So when you start trying about setting yourself up to purchase a property, understand from the very beginning that while you're working on your credit and you're doing that, that's great. The thing that you need to be more concerned about is debt to income ratio, because like I said, you can fluctuate credit, you can work on credit, you can get credit better, but in most cases, it's hard to make more money, or it's hard to put yourself in a position to where you could get rid of debt easily. The average person, if they have a car note, that car note is going to last for 3 to 4 years. So it'll be years before they can get that $400 or so back. Or if you needed to make an extra $400 a month, it's hard to show more income to make more money as opposed to just trying to get your credit fixed. So that's what I'm really trying to get you guys to understand is the majority of you, if you're not making at least $15, $20 an hour, it's just you trying to purchase a house, it is very difficult for you to be able to have to purchase the type of house that you like, still have a car that, a $400 or $500 car note and all of those things. The only way you can do it is to get the house first. Get the house first and then go back and get the car, and then you could kind of do it that way. But if you get the car first, in most cases, unless you make a lot of money, then it's very hard for you to get approved sometimes for the type of houses that you want. And that's what I really wanted to explain to you guys on today. We keep hearing credit, 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 and we might be just a step behind. The new word and new things people need to start pushing is DTI, 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 so we can understand debt to income ratio. We can't keep having a situation to where we make a certain amount of money, but we got more going out or too much going out than what we actually have coming in. So that's the new word for this year. I'm saying for the next year, for 2021. I want to keep pushing the word DTI, 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 or the phrase debt to income ratio, because we have to understand even better about DTI. Now, what I can do for you guys is I could break down another video if you guys say you want me to, and I can go in on it a little bit more. I just wanted to give you guys a brief synopsis or brief overview of what debt to income ratio is and how big of a deal it is when you start talking about purchasing a house. So every one of you who caught this information, tell your friends, tell your loved ones, share this information, like it, and let people know DTI is key. Try, if you can, to talk to the real estate agent or talk to a person about purchasing a house just right before you get the car. I'm telling you, you could buy the house and 2 months later go get you a vehicle. If you could make it for that long, this is what's stopping you a lot of times from purchasing a house. And it's such critical information because remember, the majority of you who are talking about getting financially free, or who are talking about financial wealth or leaving something behind for your children, one of the best things you could leave your next generation is a paid off home. In most cases, you have situations where you have $100,000 piece of property that you paid off, or something that's even more expensive than that, or stuff you can use for college funds. You can use some of the money from the house to start up a business, for all types of things. So when you purchase a home, you have to understand it might not necessarily be as beneficial for you where you are right now, because typically it's a 20-30 year investment, but the next generation will love you to death for it, because you're putting them in positions to be able to win. Okay, so that's what I wanted to tell you guys on today. I want to really go in and really explain to you guys about how big of a deal DTI is. And I'll say this real quick before I go, and I'll do another video on it if you guys ask me to, and I see that there's some people who are interested. But I want to break down and give you guys an understanding for all my people out there who have their own business, or you know, who doing their own business. I don't care if you, I had a friend of mine who has a bail bonding company. You know, I have some that have their own grass cutting services. I have some who just do all different sorts of businesses. And I'll do another video to break down for you what you need to do if you want to put yourselves in position to, not only if you want to buy a house, but even if you want to put yourselves in a position to start investing into homes and being able to do that. I can do a video to show you, because what you need to do to be considered bankable, which is a term that I'm starting to use now, what you have to do is a little bit different than what a regular person with a W-2 job will have to do. So I can tell you what the banks are looking for you, and what stuff you need to do to set yourself up. But the word for the year for 2021, and the word to start hashtagging and telling your friends about, and to make sure that this is running rampant through our community and we have a good understanding, is DTI, debt to income ratio. I thank you guys for being on this Mondays with Mike with me. You know, go ahead and send me some feedback, encourage me, because I want to keep on doing this. I want to do videos so I can give back. So let me know if you appreciate it, if you like it, and I'll see you guys hopefully next Monday. I'm out.